Hey everyone, Couch Investor back to another video for today. In today's video, I want to compare the three, let's say, big players when it comes to travel. Airbnb, Bookings.com, and Expedia. We're going to have a look at each and every company, compare its valuation one to the other, the growth expectations, the price targets, their latest earnings report, and then the graph as well. And we'll try and make a conclusion at the end of this video. Now, quick disclaimer, I personally own Airbnb in my personal portfolio. So, if you need a quick intro to what differentiates each and every company, here it is. So the main difference in all three, Expedia, Airbnb, Bookings, is basically in their business models. Expedia is primarily an online travel agency offering a wide range of travel services, including flights, hotels, and car rentals. Airbnb, they focus more on providing a unique accommodation and experiences directly from hosts. Whereas Booking.com, similar to Expedia, is an online travel agency but emphasizes hotel bookings. So basically each platform caters to a different aspect of travel, offering diverse options for users. Now you might say it is easier for the likes of Airbnb, for example, which is something I covered on this channel quite a lot and mentioned as well. The next step for Airbnb is to provide the full holiday package, the full holiday experience from flights to experiences. Whether they will do it or not remains to be seen, but at least right now, you know a bit what differentiates each and every company. Now, before I start, if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, would really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to get a top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So first company I want to touch on is Expedia Group. Market cap of just over $20 billion with a forward PE of 12.2 times. Now when we compare these metrics to the last 5 years, their mean, we can see that right now, for all of them besides price to free cash flow, which is a last 12-month metric here, it is cheaper. So right now PE sits at 12.2 times compared to 27.9 times. EV to EBITDA 7.5 times compared to 16.8 times, price to sales 1.5 compared to 1.8, and then price to free cash flow currently sits at 10.7 times compared to 9 times. Of course, during the pandemic, all of these stocks, all of these companies got hit, and so yes, valuation there was much higher than usual. When we look at shares outstanding, free cash flow per share, and the growth rate, we can see that Expedia has been buying back their shares in the last couple of years. Free cash flow per share has steadily increased as well over the last 10 years. Of course, pandemic period, big hit there. If we look at EPS estimates, 5-year growth rates here sits at 36.81%. Now, if we look at the average analyst price target, basically sits at the price we're at today, and that's because last year the stock was up 57%. Now, if we look at what the analysts are expecting for fiscal year 24 and 25, we can look at these numbers right here. Sales growth of 9.5% for fiscal year 2024, EPS growth of 27% year over year. Moving on to fiscal year 2025, for sales 8.6% year over year growth, and EPS here another 26.5% year over year growth. So definitely bottom line increasing much faster than the top line. Now in their latest earnings report, they said that they have completed a record $1.8 billion in share repurchases year to date. So of course in 2023, and they have a new $5 billion share repurchase authorization from the board. If we look at the major metrics here, lodging gross profit was $18.5 billion. That increased 8% year over year. Revenue sits at $3.9 billion. That grew 9% compared to the same quarter last year. B2C revenue growth compared to 2022 also accelerated over 400 basis points sequentially. And B2B revenue was at $995 million. That was a record and was an increase of 26% compared to 2022. When we look at net income, that was $425 million for that quarter, and adjusted EPS was $5.41, an increase of 33% year over year. Now, if we look at the graph right now, we can see that since the end of 2023 up until the start of this year, basically, the stock has run up more than 50%, and so we were overbought already back in mid-December. Right now we are seeing two sequential red weeks. We're sitting just at the 20-day moving average. The 200-day moving average sits closer to $115, $116, which was, by the way, previously a resistance point. Maybe that can serve as a support if we see a continued decline. Now, moving on to company number 2, which is Booking Holdings. Yes, this stock does cost you a lot if you don't have access to fractional shares. One share would cost you $3,408. It has a market cap of close to $119 billion with a forward PE of 19.8 times compared to its 5-year mean of 32.5 times. Here, just like with Expedia, valuation-wise, it is much cheaper right now than its 5-year mean. And here, like Expedia, during the pandemic time, this stock was trading at a higher premium. Now, don't worry, if you can't remember all these metrics at the end, I will show you in one picture all 3 of those companies with all of these metrics so you can screenshot it and compare it later on. With Booking, the same story continues as with Expedia. They have been buying back more of their shares in the last couple of years. Free cash flow per share has been increasing throughout the years as well, with a hit during the pandemic. And here the EPS estimate 5-year growth rate sits at 20.43%. If we look at the average analyst price target, here the price target sits 6% higher than the price we're at today. And with regards to what the analysts are expecting for the top and bottom line in the next 2 fiscal years, for fiscal year 2024, sales growth of just under 11% year over year, EPS growth of just under 18% year over year. With regards to fiscal year 2025, sales growth of just under 10% year over year and EPS growth of 19.61% year over year. So here as well, bottom line increasing faster than the top line. If we look at their latest quarterly earnings, which was in November, gross travel bookings, which refers to total dollar value, generally inclusive of taxes and fees of all travel services booked by our customers, net of cancellation, were $39.8 billion. That's an increase of 24% year over year. Room night books increased 15% year over year. Total revenue was $7.3 billion. That's an increase of 21% year over year. Net income, $2.5 billion, an increase of 51% from the prior year quarter. Net income per diluted common share, $69.8, an increase of 66% year over year. Now, if we look at adjusted EBITDA, that was $3.3 billion, an increase of 24% year over year. So again, pretty strong quarter, remarkable year over year comparisons. And here, if we look at the graph, which looks a bit similar to what we've seen with Expedia, back at the end of October, we have seen this stock rise quite a lot. And here as well, it was overbought mid-December. Since then, here we have one big red week, which has started the year badly, just like most stocks in 2024. Currently, we are also sitting at the 20-day moving average, with the 200-day moving average sitting just under $3,000. Last one, third company here is Airbnb. One share will cost you just under $136, market cap of $87.15 billion. Last year, the stock was up 55%. Here as well, you might be surprised, but here as well, all these metrics are cheaper than in the past 4 years, with PE being much cheaper here, 30.7 times compared to 91.7 times, EV to EBITDA 20.1 times compared to 40.5 times, price to sales 8.1 times compared to 12.3, and price to free cash flow, that's in the last 12 months, 20.5 times compared to 45.5 times, which makes this price to free cash flow not that expensive at all. Now, how can this be? I thought this company would be more expensive, right? Well, of course, it is more expensive than Bookings and Expedia, but still, this is a company that is growing quite fast, top, but especially bottom line. If we look at shares outstanding, this company has been buying back their own shares, not the same quantity as the other two, but their share buybacks should tackle the dilution issue. If we look at free cash flow per share though, that has increased quite a lot. And here we see the EPS for the 5-year growth rate sitting at just 6.12%, so much lower than the other two companies. If we look at the analyst price target, it's basically the price we're at today. Then looking at what the analysts are expecting for the next 2 fiscal years, so sales growth of 11.57%, EPS decrease here of 46% year over year. In 2025, fiscal year 2025, sales growth 12.33%, EPS 12.58%. So they are expecting fiscal year 2024 for the company to take a major hit at the bottom line. Looking at their latest earnings report, Nice and Experience book increased 14% year over year. Gross booking value, or GBV, increased 17% year over year. As for revenue, that increased 18% year over year to $3.4 billion. Net income, $4.4 billion. Adjusted EBITDA, $1.8 billion. Net cash provided by operating activities at $1.3 billion. That's up from $964 million in Q3 2022. And free cash flow of $1.3 billion. And that's up from $958 million in Q3 2022. And this is what I meant with the share repurchase programs. So in May 2023, they had authorized up to $2.5 billion of repurchases. During Q3, they repurchased $500 million of common stock and have now repurchased a total of $1 billion under this authorization. And like I said, the share repurchase program has enabled them to offset dilution from their employee stock program. And here, if we're looking at the graph, we can see that we've hit, again, that same resistance we've hit before back in September and back in July at around $150. Unlike the other two companies, we were not overbought. And here, over a longer period of time, actually since the start of 2023, we have been making higher lows. Now, currently, the company is between the 20 and the 50-day moving average, with the 200-day moving average sitting just under $130. It sits at $128, $129. And so, to conclude, as promised, here is a fuller picture comparing all three companies: PE, forward PE, EV to EBITDA, price to sales, price to free cash flow. You can pause the screen to look at it a bit closer. But I mean, to me, it's pretty clear, right? Airbnb being the more expensive company here, the other two being a bit cheaper, and overall, Expedia is the cheapest of the bunch. Now, as you can see, Expedia and bookings, although not as popular as Airbnb, right? Especially not among, I think, the younger investor, but most investors as well. You hear way more about Airbnb than you hear about bookings and Expedia. But if you look at what the analysts are expecting, they're expecting way more growth top and bottom line from the likes of Expedia and Booking. So some might say that there is maybe an opportunity here for all of us that have been looking solely at Airbnb. Maybe we might turn our attention to one of those two companies. It's certainly on my radar. I have no intentions on selling Airbnb stock right now, but it's certainly interesting to see these results. So, of course, you want me to answer that question, which one is a better buy? Well, I hope you can answer that question as well. Right now, purely looking at those numbers, I would say Expedia looks like a better buy right now. That doesn't mean that Booking won't be a great stock to buy and hold for the long term. That doesn't mean that Airbnb won't be one. But purely looking at current valuations, current expectations, it does seem like you're getting a deal by going with Expedia, then Booking, and then Airbnb. Of course, that's just my opinion. That's just my conclusion looking at those numbers. Do share yours down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.